Jesus. If this is a measurement of the scale of our bubble, and it is, that is saying this is horrifying. This is absolutely horrifying. If this reverts to the mean, we are talking about a modern dark age. This isn't like 1929 to 32. This is going to be, this data is absolutely horrific. This is the informed people on the Titanic getting into the lifeboats like right now. That is what's going on. Hi, it's the Gold Silver Show with Mike and Alan again. Alan, how are you doing?
I'm great, Mike. Thanks. How are you?
Great. So you've got something on, I've been collecting data on overvaluation, and I just did we released the Limitless Expo that I did a few months ago. And I showed the overvaluation on certain metrics, but you've got a whole bunch more for us, don't you?
Yes, I do. I've been collecting some charts and articles and facts and figures over the last few weeks that show just how insanely overvalued the U.S. stock market is. So I thought we could go through that today.
Great. I want to encourage everybody to go and watch the overvaluation that I talk about in the charts at the beginning of the last video that I did, the Limitless Expo, and connect the dots with this one.
Yes, I think they go hand in hand.
Yes.
So yeah, everyone check that out. And then our agenda for today, we're talking primarily about the U.S. stock market. And I want to look at 5 things, basically valuation levels in a global context. I want to look at what asset managers are doing. Are they allocated very heavily to stocks or not so much? I want to look at companies' earnings, particularly zombie companies, and see how many of them there are, more or less. Are they growing or shrinking over time?
Yeah.
And
Define zombie company for us right here, though, so that people don't get lost.
Sure. A zombie company is a company that is not earning enough money to pay the interest on their debt. So that's just the
Right.
interest on their debt. So
Yeah.
that's a big problem. They can't
Let,
stay
al-
afloat.
let alone the principal. So,
Exactly.
right.
Yeah.
Right.
Yeah. So generally, that means they're going to have to keep borrow against their assets, or go deeper into debt in order to just stay afloat, and hope that things turn around somehow. So sometimes they turn it around, but many times they don't. So we're going to look and see what that trend is like.
Yeah.
Also, I want to look at what corporate insiders are doing, right? Are the CEOs and other executives, are they buying more shares of their own stock, or are they selling? What does that look like? And what is Warren Buffett doing at Berkshire Hathaway? Arguably the best value investor of all time. Is he seeing a lot of deals right now or not so much? So that's what I want to look at. I think it's a pretty wide variety of things.
Excellent. Let's do it.
Let's do it. All right. First of all, we've got the S&P 500 market capitalization as a percentage of world GDP. So how big is the US economy compared to the rest of the world? And from the Kobayashi letter here, the S&P 500's market cap to world GDP ratio officially hits a new all-time high of 46%. Look how high this is here.
Wow.
So over the last 15 years, this ratio has quadrupled. So it's even higher than the dot-com bubble peak in the year 2000. And the market cap of the S&P 500 is over $50 trillion for the first time in history. And the U.S. stock market cap to GDP ratio has hit an all-time new record high of 205%. The U.S. stock market has never been bigger.
Never been so overvalued. Never been bubblier. It's bubblicious.
It's published. Mike,
Right.
other people would say it's because the economy is super strong. Everyone's doing well. Individuals are doing well. Companies are doing well. We've got a new administration coming in. I don't know. Maybe we can keep that in mind as we go through the presentation and see if it holds up.
The overvaluation of the stock markets is something that I've been warning about for quite a while now. And this is the problem with it, is you don't know when the bubble is going to burst. In 2005, 6, and 7, I was going through the exact same thing. Warning people, get ready. Everybody was on the real estate bandwagon back then. That was the biggest real estate bubble we've ever had. And I was touring the world with Robert Kiyosaki. I was presenting all of these charts. I mean, in my last video, I disclosed that Robert's group used to call me the angel of death because I would bring the depressing news to everybody. And everybody thought that I was wrong, that this thing will keep on going forever and that they're all going to get rich on leveraged real estate. And just a couple of years later, when the bubble popped in 2007 and the global financial crisis hit in 2008, everything fell apart in the real estate sector. Real estate dropped by about 50%. Gold tripled during that period of time. So if you had sold a home in the peak and then bought gold and then bought back into real estate down in the trough, for every home you sold, you would have been able to pick up 6. And the most of the people that I was talking to in that audience were broke by 2011. And I had from 2008 to 2011 it was just absolutely amazing. So anyway, so this stock market capitalization, this could go on a while longer, but I do know that it's getting closer and closer and closer to us. And this is like being strapped to the railroad tracks with an approaching train. But we just don't know when, how fast is that train traveling? So when is it going to get here? Go ahead. I'm sorry I interrupted.
No, it's no interruption at all. It's always great to hear that. And I totally agree with everything you're saying. And a lot of these asset classes, they take turns, they revert to the mean. And so it's just a matter of time. It's a question of how patient you can be. And speaking of reverting to the mean, we're going to wonder here if this is going to revert to the mean. US stocks are very exceptional, quote unquote, relative to European equities. So this is the US versus Europe equities price in US dollar terms. And US stocks are trading at a 75-year high in relative terms versus European equities. Do we ever see anything even vaguely resembling mean reversion? Or is Europe just toast? I mean, look at this. This is unbelievable.
Yeah.
This is 3.5 standard deviations above the mean. That's such a rare event.
Right.
Yeah.
I can't remember 3.5 standard deviations, what the percent probability of that is.
Over 3 standard deviations, I think that's 0.5%.
Okay.
So, and to either extreme, so total, so 1/4% high, 1/4% low, I think, and that's 3 standard deviations. 3.5, of course, is much further in the tail. It's much less likely to occur. So yeah, and if this thing turns around right now, then okay. But if it keeps going and hits 4 standard deviations, I mean, that's just insane. We're talking like almost a 1 in a million event.
Yeah, it either means that Europe is like gone, or there's a big crash ahead of us. One or the other.
Yes, and it's certainly not a normal.
The U.S. just stagnates and Europe grows and grows and grows. But we know with their, in Europe, their economies are much slower because they are much more regulated. They are much more socialistic, and so their economies have been sluggish for a long time. Where on our economy, except this, the last bottom in this was the global financial crisis of 2008, and so we've been growing faster than they have ever since then. If this started back in 1985, 1990, when the NASDAQ boom started, look at that. It only got up to the red line at the NASDAQ boom. And that red line, actually, you know what? This chart is drawn wrong. I'm sorry to say that to Markets and Mayhem, but you can't, when you're talking about that red line is not the average. That needs to go down lower. You can see that. Disregard everything after 2015. So yeah, even 2014. And then imagine everything before that. I'm pointing the wrong direction. I've got to turn this around for my camera. Everything before 2014, pick an average there and move that line to where it's a mean when we're not in what I call the bubble century. And then you've got to drag the first and standard deviation lines down a bit, or the first, the minus, I guess. Yeah, they would both come down. That would come down just a tiny bit, but yes. So that changes the whole scale here. I have a feeling we are over that 3.5%. We're probably over 4 at this point. So what's the percentage chance of a 4, a standard deviation of 4?
It's probably like 1 in 100,000. It's
okay.
Rare.
Right. Okay. So that says, Jesus, if this is a measurement of the scale of our bubble, and it is, that is saying, this is horrifying. This is absolutely horrifying. If this reverts to the mean, we are talking about a modern dark age. This isn't like 1929 to 32. This is going to be, this data is absolutely horrific. We should move on. I think I've said, you got anything to say about that? If you readjust this for the mean before the bubble century, you can do this visually. What do you see in this chart?
Yeah, basically, these standard deviation lines would be below the peaks here because you get 67% of the data points between plus or minus 1 standard deviation. So we would actually, by definition, by feature of a standard deviation, we would see a third of the data points above and below those 2 blue lines if we moved them down. So everything we're seeing since the bubble century is so far off the chart. It's like we have to rewrite what is normal. And I use the word normal because of a normal distribution. This is so abnormal, it's very hard to quantify it or put it in perspective.
I can see what is going on with this chart that skewed the data a little bit, is just like when we do an index chart. This started off as a factor of 1, like an index chart. It's not starting off with the mean, the average of the swings before the bubble century started, before everything went crazy. And that's where it needs to start to give us accurate data. So this just started at a factor of 1 when it was actually below the mean for from 1950 to 2008. I wish this data went back even further. I'd like to see this data going back 100 years. But yeah, so now that you've seen that, would you consider this to be over a deviation of 4?
Well, it depends so much on how you calculate it, but it looks like it's about 3.5. Obviously, you could calculate it differently to come up with 4.
Right, but they're taking a mean that is not a true mean. The mean is much lower. It should be, that red line should be down closer to the factor of 1 on there. Not quite. That would be a little bit low, I guess. But the average ratio from 1950 to 2014, 2015 is much lower than that red line. The red line is skewed up. We're it looks like at about 3.7 on this chart. So I would imagine that we're up at 4. Yeah. So, okay.
Yeah, certainly overvalued. We can definitely agree with that. So
horrifically overvalued.
Yeah. So I would expect a mean reversion, but we shall see. So what are the asset managers doing? Well, asset managers are all in on U.S. stocks. Asset managers' net positioning hit near a record 98%, meaning they are almost fully invested. Such extremes have only been seen a couple of times before. US stock market optimism is through the roof. What is going to happen next? So this is kind of a weird chart to wrap your head around. This is basically the rolling 3-year percentile of net positioning among asset managers. So basically every data point we see asks the question of, okay, right now, and I think it's monthly data. So right now, this month, what percentage of the asset manager's portfolio is invested in US stocks relative to each month the last 3 years? So if it's up at 100 percentile, that means that monthly allocation is the highest they've had in the last 36 months, I believe.
Oh.
So it doesn't necessarily mean they have the same percentage of their portfolio invested every time it hits 100. It just means that it's the highest allocation they've had within the last 3 years, anytime it hits 100.
Okay. I didn't read the side scale there, the rolling 3-year percentile of net positioning. And this is something that I want to point out. Everybody needs to go to GGSR 21 and read the chapter 3 of the Great Gold and Silver Rush of the 21st Century. It's all about how to read charts and how to see if somebody is skewing your perception. That changes everything. I wish this was a percentage of cash to investment, just their total position. What's on their book? How much cash do they have? Because if this was at 98%, that means they would only have 2% cash if they were measuring it that way. But they're not. Still, for the past 3 years, since 2022, this is an extraordinary position here. So
it basically shows that these asset managers have been allocating more and more and more to stocks over the last 3 years.
Right. And you know what? Look at how wrong they are most of the time. 2011 was the time to be buying. It wasn't the time to be not allocated into stocks. That was the time to go all in, right? We had the crisis of 2008 and we hit the bottom. Look at where they were in 2008. They were all in when the crash started, the global financial crisis. And so they're typically very wrong. So with it up at 98%, it says that they are on the wrong side of this trade. They should be, if they want to be fully invested, they should be fully invested in gold and silver. So,
yep.
Yeah, let's move on unless you got anything else to say about this chart.
No, it just, they do seem to get it wrong. And we got to ask ourselves, like, okay, how about the companies themselves? Are they performing well? Are they strong? Are they able to service their debt? I don't think so. This is a chart of zombie companies. As we mentioned at the beginning of the video, a zombie company is a company that's not earning enough money or currency to service their debt, the interest on their debt. So they have to borrow just to pay their interest. They can't touch the principal. They're really hurting for cash flow. And we can see, Mike, do you want to talk about this? You put it in the book and you had a nice write-up there explaining kind of the peaks and the troughs and why this takes shape. Do you want to explain it here?
Okay. Well, basically, if you look at where it was, Dan, if you could enlarge that one more time. So back in the year 2000, we're coming off the NASDAQ bubble. Everybody is making a lot of profit. And then the bubble popped, the stock market falls, the economy gets bad, the companies are not making as much profit during that. When the economy takes a big slide and we go into recession, the companies aren't making as much profit. And then it peaks in 2003, 2004. That's where the economy started to recover. So the reason that this line goes down again is because the companies become more profitable as the economy grows and their sales pick up. But they did not pay down their debts. Alan Greenspan took interest rates down to 1%, and they kept on borrowing. So when the next crisis hit in 2008, the economy shrank horribly during the global financial crisis, and this rises until 2011, and then the economy bottoms at that point. So it isn't under the company's control at this point. They've got long-term debt that they are stuck with. What they've got to rely on is, and a whole bunch of companies go bankrupt in those years right after the crash. When the economy starts to shrink, as it did in 2000 through 2003, and as it did through 2008 and 2011, that's when a whole bunch of companies go out of business. But even though companies are going out of business and falling out of the S&P 500, this is the S&P 1500. Even though they're falling off of this list, they are those companies. There's still more of them, the companies that are in the S&P 1500, taking their place as zombie companies and growing. And so the economy recovers. This line goes down. Ben Bernanke took interest rates down to 0.1% on the Fed funds rate. And so these companies, instead of paying down some of this debt, just kept on borrowing and borrowing and borrowing because it's free currency. And then we go to a place that we've never been before, where 1 out of every 5 companies in the U.S., more than 1 out of every 5, is a zombie company. 20%. Is that? Or is that, no, that's 12.
Yeah. 20%, 1 in 5.
20%. Yeah. Okay.
Mm-hmm.
So yes. And we are just in this danger zone that, and so this ends in late 2022, right? When the book was published. Yeah. Okay.
Yeah, so we have an extra 2 years of data. Now, it's really hard to find this data because you've got to compile it, on an individual company basis. So it's very difficult. But some other companies have made some estimates. And so the number of zombie companies in the US is skyrocketing. This is from October of this year, so certainly much more recent. 43% of the Russell 2000 companies are now unprofitable, the most since the COVID crisis. So they're talking about
43%. Oh my God.
Yeah. Now they're talking about the Russell 2000, whereas what we were just looking at
So
was
it's more companies instead of 1,500. The Russell 2000 incorporates the S&P 1500. Those companies are in here. This is 2,000 of the publicly listed companies in the United States. Wow.
Yeah. And so this is the chart here. The share of Russell 2000 companies with negative earnings continues to rise. And you can see where we're at here.
Okay, so the Russell 2000 must include some less profitable companies than because this chart it goes back to 1995. The other chart started in 2000, and this shows it up at about 16% or so in the year 2000, where our chart showed it at 3%, I believe. So it's including the extra 500 companies are weak companies compared to the first 1,500 or 500 or whatever our last chart showed. So this isn't an increase from 20% to 45%, but still, this is incredibly alarming.
Yes.
Yeah, it's still, so this includes a lot more publicly listed companies. And there's, the Wilshire 5000 used to include 5,000 publicly listed companies, but it doesn't anymore because there aren't 5,000 publicly listed companies. They grow, they merge, and now there's about 3,500. So this is the bulk of that 3,500. So as you get into these smaller companies, you get into weaker and weaker companies, it looks like, because this whole scale is shifted up. You can see that rollover from 2021 to 2022. That was in our last chart, and it ended there in 2022. So this, and it's headed up again as of March or April of 24. So, and here we are much later in the year. If it was headed up on that trajectory, it's probably higher now. So yeah, this is bad.
And this is over 40% of companies. So that's 2 out of 5 companies is negative earnings. I mean, this is just unbelievable. And so
It is.
I mean, like, how does this resolve? Either there's massive bailouts or massive bankruptcies. I mean,
well, massive bailouts. The currency has to come from somewhere, and a bailout from the government comes out of our pockets. If it's a bailout by telling bondholders in these companies that, sorry, you're not going to get paid, but the company is going to go on surviving, or maybe we will swap your bonds for some shares in the company or something like that to get rid of the debt instantly, then it comes out of the investors' pockets. But either way, it doesn't come out of the company's pocket. Either the company goes bankrupt and it's gone, or it relies on basically theft in some other form, like government bailouts where the taxpayers get the bill for the next 10 years.
Yeah. Yep. Not good. Not good one way or another.
But this is saying, so this is what how many companies out of?
Well, we're 43%
Oh.
out of
What are you
2000.
talking about? Right. Imagine driving down Main Street in your town and 4 out of every 10 stores are boarded up. That is a really, really bad recession. It's worse than the Great Depression. That's what this is saying.
Yep. Yep. Hopefully there's a nice way out of it. I'm
Right.
hoping. I'm
Yeah.
hoping. One last thing on zombie companies, an article from Fortune. And this is back in June, so it's a little bit old here, but it's kind of besides the point. The number of debt-laden zombie companies soars globally to nearly 7,000. Okay, and if you read the article, they estimate about 2,000 companies in the United States.
Wow.
So 2,000 companies. I mean, that's so many, man.
Yeah.
So yeah, that's
where it says many of these publicly traded firms won't survive. Hi, I just wanted to take a moment and thank you for subscribing and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer. And now back to the video. Many of these publicly traded firms won't survive. They won't survive the next crash. They won't survive the next big recession. And I do believe the energy that is stored up from papering over, printing our way out of every crisis, every recession, the 2008 global financial crisis, the COVID crash, they printed their way out of it. That is, you've got cracks in the foundation of something, and you just put a little piece of paper over and paint it, and the crack is still there. It's just got a coat of paint on it, so you can't see it any longer. And the cracks are getting worse. 7,000 companies. That's amazing.
Yeah, that's globally, and then 2,000 in the U.S. So,
Yeah.
so many, so many.
Right.
So what are the executives doing? What are the CEOs and so forth doing? Are they buying their own stock because they have conviction in their companies, or are they selling it? Well, according to Ronnie Stoufferle, insiders are selling at a degree never seen before in history. And these are corporate executive stock
history
sales.
only goes back to 2004. But
yes,
yeah.
It's not a very long history here, but still an interesting trend.
I used to show the buy-sell ratio charts back in 2004, 5, 6, 7 to real estate investors and stuff, but just showing that there was this was a general, just like this is. This is S&P 500. I think this is the data that I was showing back in 2004, 5, 6, but it went back much, much further than this. But yeah, it was bad then. Those peaks back in the very first red line on this graph. Yeah, that's what I was showing way back then. So yeah, so go on with what you were saying. I'm sorry I interrupted.
Oh, no worries. And by the way, you got to send me that data set. I love a good long-term data set.
Yeah.
But anyways, so the blue line here is the S&P 500 index. You can see it's been climbing a lot, especially lately.
Yeah.
And the red columns here are the ratio of sellers to buyers. So among
Right.
corporate executives, how many of them are buying their stock versus selling their stock? And you can see that we're up at around 5.5, almost 6, meaning that for
6 to 1.
yeah, 6 to 1. So for every executive that's buying their own stock, there's 6 of them who are selling it. So
Right.
they're cashing out, they're taking their gains, and we haven't seen a ratio that high in 20 years.
Yeah.
Do you remember, Mike, when you looked before 2005? Do you remember how high that ratio got previously?
It's never been this high, I don't think. I think Ronnie is right that this is never before seen in history. But one of the things I want to point out, look at the blue line and look at the global financial crisis of 2008. That little tiny dip down there. Look at where we are today. This whole thing was insane.
Yep. That's the whole point of the presentation.
Yep. Yeah.
This is insane.
This is crazy. And so these 6 insiders that are the company executives that own stock in the company selling versus 1 buying. This is the informed people on the Titanic getting into the lifeboats like right now. That is what's going on. Those 6 have pretty good information on what's going on in the economy and everything else. And I think they're looking at these overvaluations and they are heading for the lifeboats right now. So, because cash, that's your lifeboat. Cash, gold, silver, crypto, your lifeboat. Cash is always going to get diluted. And we have seen the results, the amount of currency that was created during the COVID crisis. Some of it went into like direct cash payments to the public and came back to haunt us as raging inflation that wiped out people's savings and stuff. And so cash isn't something, I think, on this go around, because the Fed has shown its hand. The only thing they can do is create a bunch of currency and drop interest rates and hope that the banks also create a bunch of currency every time there's a crisis. So they dilute the currency supply, diminishing your purchasing power of your dollars, which causes things like gold and silver to rise to compensate for that loss of purchasing power of the dollar from the dilution of their response to a crisis. So get ready.
Yep, exactly. And so my final question here is what is the arguably best and most famous value investor of all time doing with his currency? Is he buying a ton of stock? Does he see a lot of attractive opportunities out there? No. Berkshire Hathaway's cash position has just hit a record high of around $300 billion. This is the Berkshire Hathaway's cash position over time. And look at its spike here. They've never held this much cash, not even close. I mean, they've really doubled it from just a couple years ago. Warren Buffett basically sitting on the sidelines, right? If he saw a lot of attractive opportunities in the stock market, he would be gobbling them up. But we know he sold a bunch of Apple stock lately, a bunch of bank stock, and he's sitting in cash. So what do you make of this, Mike?
Well, this is one of the most informed people that there is. And he is getting ready to scoop up some great deals. That's the reason he's got cash on the sideline. He knows that everything is going to be falling, and he's going to be looking for the most likely survivors of the devastation. All of this data. And I do, again, want to encourage people to go back and watch the portion of my presentation at Limitless that has all of the overvaluation charts. It's very important to couple those with all of this information. Warren Buffett is getting ready for the biggest thing that has happened in his lifetime. And how old is he?
89 or something like that.
Right.
Yeah.
So
he's seen some things.
He has. Right. Yeah. And he knows that there's going to be some screaming deals out there that he can pick up.
Exactly. Once those zombie companies go bust, he's going to be there to scoop up all the assets at a massive discount.
The assets or the companies that do survive, their stock is going to be incredibly depressed. He'd probably be buying a surviving company that's well managed and then having that company scoop up the assets of the companies that went broke.
Exactly. Amazing. Well, Mike, you have been having this conversation with our audience for years now. And so I wanted to end with a meme. You haven't listened to a single word I've said, have you? What a weird way to start a conversation.
Excellent. So I want to remind everybody to like and subscribe. Thank you very much, Alan, and we'll see everybody in the next video.